Welcome to TMS Insights. We're now into May and we're in the run-up really to the end of financial year, but so much has gone on. Last time Ben and I were here on the TMS Insights, then markets were very different. It was
just trying to think about when.
Yeah,
was it after Liberation?
Just after Liberation Day, April 2, markets were pretty much free falling, and those days were pretty grim. But they didn't last long. No. And what a lot of people who aren't aware that beyond mainstream media, you can report good news for markets. The market's recovered well more than it's lost.
Yeah.
And is now above that level.
Yep. It's had a big bounce back. Hasn't been a lot of change in the news, but I think, what has eventuated since Liberation Day has been a much better than expected US quarterly earnings season.
Yeah, that's true.
And earnings move markets more fundamentally than short-term tariffs. And the other thing I think has been the change in the interest rate outlook is quite pronounced since the start of this year, which is also a tailwind for equity. So we've got the RBAs coming up, and I think the bond market now has 3 or 4 rate cuts still priced in for this year. US has got 3. So
if we said earnings and rates are the real things that drive markets, and they're both looking better than they were, to actually explain to somebody why the market shot down so far, it's not actually about either of those things, but the role of expectations. And it was puzzling to us, and might have come out in that last insights, but how much the market fell because tariffs were, a lot heavier than were expected by the market. And it's puzzling, Ben, though, it fell all that way.
Yeah.
It didn't last longer. That's the part.
It is. It is. And I just think trying to read what was next and the uncertainty of it all, as we all know, is the most overused term in market tutelage, is markets hate uncertainty. But I think it was also the wrong stepping, Jez, where no one thought that tariffs would become an issue post an election win. And Trump just kept going at it and pretty early in his presidency.
And globally and in really heavy ways to emerging markets as well. So, so we're sort of in a period now, we're in that 90-day pause period. So it hasn't ended, but there's been some very positive discussions, we believe. But Ben, I read one major fund manager had 3 ways of going about dealing with this. A bit more in cash, a bit more in private equity, and not listening to every Trump tweet. It's not a bad way forward. So let's get back to the things that do matter, because I think the Trump tweets are probably a really bad thing to react to. That's certain. Let's talk about earnings. US earnings, good numbers. And in the shadow of the tariff discussion, which could have seen the guidance being weaker than it actually was.
Yeah, I would say, I listened to a few of the quarterly results this time round just to get a feel for because it is, and I'd say that if I was summarising it, CEOs broadly were optimistic in where things are up to today and what's going on in the ground today, but they're cautious about a change coming, and that's particularly the case for US companies that are heavily exposed to US consumers. I felt like there was a lot of removal of guidance without a change in guidance. The highlight was the big technology shares, which had sort of got hit the hardest during the Liberation Day sell-off. But this AI thematic is not going away, and for me, the Microsoft result was the standout. It was an unbelievably good result.
Azure
was the standout within the Microsoft, and they sort of said all they could see was an acceleration in customer buying behaviour. So that AI thing it almost feels like there was so much hype around it 6 months ago. It's almost like it's been forgotten now, but nothing that hasn't changed either. That you want to have companies with exposure to that thematic. And
definitely.
Google had a great result as well.
Amazon,
the prime part of the business, a little bit softer. And, we did see some companies like Visa coming out and saying that they had seen some start. They felt like there was a bit of a change happening in US consumer spending behaviour. Block was sold off on the back of that as well.
Apple was a bit mixed.
But overall,
collectively,
it was much better than expected.
Good reporting season.
Yes.
And I really thought guidance would be a bit weaker, but as you said, some companies said we're just removing guidance. So they're dealing with things. They're very innovative, and a lot of these companies have got tremendous global management, so you can actually redeploy assets. But
the other thing, can I bring up, was please. We had this big Macquarie conference on
Gold Coast
in Sydney, and I think nearly 2/3 of the ASX 200 companies presented, and I reckon everyone was expecting a number of downgrades to come through because pretty much everyone gave an earnings update.
Yeah.
But there was just a lot of reaffirmation. So it wasn't exciting, but that maybe is a good outcome. And I think that's given our market a bit of a shot in the arm as well.
And we also did hear from some companies since we've heard from the banks, a number of the major banks.
Yep.
We've heard from REA Group.
Macquarie.
We've heard Soul Patts, Brickworks.
Yep.
And if we talked about the banks, Macquarie was last week, wasn't it?
Yep.
So, and they've been sold off heavily. They are. The high beta stocks get more selling.
Yeah.
But they've also sold off one of their asset managers. So they're looking a bit different too as well.
Yeah, continuing to change their spots. And that was a bit of a surprise to me, Macquarie. Yeah. But I would say, I've got quite a lot of friends who work at Macquarie. They reckon over the last few years there's been some pretty full-on redundancy sweeping through. They reckon about 1 in 20 people have been made redundant. So, you get the downturns in the cycle. Macquarie is very good at, rationalising its cost base quickly.
Yeah.
And then if you get a bit of a pickup, it's on a lower cost base, the profit. So it wasn't a great result, but it was better than the market expected.
Yeah. And then the retail banks, if we call them those.
Yeah.
NAB
was good.
It was the best, I think.
And that was the business banking division was the main driver there. But again, you wouldn't say exciting.
No, it's not high growth in that regard. Talk to us about a stock which people would regard potentially as relatively boring, but it's been anything but. Soul Pattin's.
Yeah, well, that's that got as close to an all-time high, and I just think there's a real reaffirmation. Look, one thing I've been saying to clients over the last few weeks is there's a misconception can be that when you get these periods, that fund managers retreat to cash, and of course, Perpetual or the big managers in our market, they're always pretty fully invested. A large cash weighting might be 5 or 6% instead of 2%, and so the only levers they can really pull to try and protect capital if they're worried is to move money out of growth stocks or cyclical shares and to go into defensives. So, they're like infrastructure stocks, property stocks, Woolies, Wesfarmers, Soul Patts, Telstra has been strong, and it very much feels like we've had a bit of that. And one thing I've been saying is you almost want to go the opposite direction where, there's a lot of these safe defensive stocks look quite expensive now. And because there hasn't been a change in their outlooks other than maybe the interest rate outlook, which is a lot of them are rate sensitive. But
the growth stocks, some of them sold, a lot of them sold off, but a good number have bounced back a fair way too.
Yeah.
So there are still some that are not.
Yeah. It's a bit harder now. Like I think after the market's digesting it, and it feels like the few stocks that everyone's had their eye on, they were always the first to bounce back pretty hard.
That's it.
But look, things are calming, I suppose. You're always a bit wary that we might get another fuel up.
Sure, won't be the last little flare up from Washington. Let's talk about Canberra though, because people would obviously be interested in the fact that we've had a re-elected majority Labor government, and it looks like we've been keeping an eye on the Senate here a bit. Looks like the Greens and Labor might be able to control the Senate, which could have some impacts for some legislation.
Yeah, well, look, I think whichever political persuasion you go, what we did, I think most people want to see as a majority government, not a hung parliament.
Yeah.
So at least, and I think the market has, part of the reason we've had a bit of a bounce locally has been at least we've got one party that's ruling. Absolutely, I guess the super tax changes are the big talking point in our industry, and Labor struggled to get those, couldn't get those through in its last term because of some independent senators that stood against it. There's some in I think our opinion, my opinion, there's some crazy stuff in there around taxing unrealised capital gains, which would make us a world first, and not indexing some of these changes also, I think, is not
but
great.
It's really important that people understand who it might affect.
Right.
Are those with a balance,
Individual member
member of $3 million or above.
Yeah.
So if you're in that category, speak to us. If you're not, all the discussion we've had or you might have read about doesn't apply to you now. But that indexing that Ben mentioned means it might in the future. And even for young people, it's going to be something, if it's not indexed, it'll apply to a huge number of people.
Yeah.
So it's going to become a really punitive new tax.
I mean, I was reading, I think someone was saying in the office that anyone that goes into the workforce this year will have more than $3 million in their super fund when they come to retire, and will actually cop this tax, and that's for everyone. So, look, the first thing we should say here is that the question, we do have clients, a number of clients who are going to be affected by this, some more than others. What do we do now? The what do we do now is we wait and see if this passes.
It passes the Senate,
and then what it looks like when it does pass, because I think it will continue to change as it goes through, and maybe these things get fixed up. So that's step one, and then once we know what the legislation actually looks like, then we come to thinking about what we do about it.
Yeah, you can't worry about things that haven't happened, that's for sure.
Or make decisions on things that haven't happened would be even worse.
Otherwise, and we're just winding up now, we are coming into the end of the financial year, so there are things to do. I mean, tax loss selling, people got to pay pensions, and then you start the new year with a fresh sheet of paper.
Yep, contributions, making sure you've maxed those. So we do run checks on those internally. We'll be keep an eye out on emails in the next month, because we will be coming through. Always, as always, it's up to so the obligation of the directors to make sure that the super fund's compliant. But we work with you to make sure that's happened. So if you're going travelling, as an example, or something like that, touch base before you go. Make sure you've drawn your minimum, you've maximised your cons, and we'll work with you over the next 6 weeks.
Good stuff. All right, that's all we've got time for. We will bring an update to you again in June.